Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Justin Tyler, who is the co-founder and director at Daintree Capital. Justin is going to be talking to us about what's going on in the fixed income and credit space and the opportunities and risks therein. Justin, thanks so much for sitting down with Livewire today.
Thanks, Chris, for having me.
Justin, this is the first time speaking to the Livewire audience. Can you just tell us a little bit more about Daintree Capital?
Happy to. So Daintree Capital was formed in 2017 by Mark Mitchell and myself. We're a joint venture with the staff owning 50% of the company and perennial investment partners owning 50% of the company. It's a good alignment of interests. It is also a very good partnership. You know, Perennial will provide all sorts of things in terms of the sales and distribution backup that we need, operational backup, legal compliance, all of that sort of thing. So in that way, you know, Daintree has a typical sort of boutique structure, and we think that brings a lot of advantages to investors, as I've said, in terms of alignment of interests.
Justin, let's get straight into it. There's plenty going on in the fixed income and credit space right now. You've previously noted inflation risk and growth risk as dual concerns. So I just wanted to understand how Daintree is thinking about both of those risks and then how you prioritise them.
This trade-off between growth and inflation is something that markets are really concerned about at the moment. For us, inflation is the nearer term risk. I mean, we've all seen what's happened with the recent inflation data. However, we think that policymakers will do what they say that they are going to do, and that adjustment will potentially push growth a little lower going into next year. So for us, it's just a matter of sequencing and having a portfolio in place that can deal with both of those.
Let's also focus on yields and credit spreads. So credit spreads somewhat tighter, for example, here in Australia versus other markets. Where do you believe there's value at the moment, Justin?
What's interesting there in what you said, credit spreads tight, yes. Credit spreads tight in Australia versus other markets? Actually, no. Right. What's interesting is that if you go back even 10 years or more, it's not unusual for credit spreads in Australia to actually be better value than offshore. And that's what we find now as well. So credit spreads in Australia are around, all in yields, I should say, 50 or 100 basis points you're picking up for being in Australia after currency hedging, because everything gets currency hedged in fixed income. So that makes it a happy hunting ground. And so most of our portfolio is in Australian risk. But if obviously that changes and credit spreads offshore blow out, then we'll be very happy to move into offshore markets. But for now, Australia's where we are mostly investing.
Yep, so a bit of home cooking there. And then potential risks. You talked a little bit about there, but where are you seeing potential risks in the global landscape?
There are many.
Yep.
And in terms of risks, there are the risks that you can sort of potentially foresee, and those that you can't. The risks, unknown unknowns, if you like.
Rumsfeld, yep.
Yeah, exactly. So for us, the inflation story is one we're watching very closely, as you'd expect. If inflation becomes longer lived, it gets entrenched again. We don't expect that, but if it does, of course, you've got to react appropriately. One of the ways that we do that is we're already doing it. We don't have a lot of fixed rate duration in our portfolio. We think people have way too much interest rate risk in their portfolios, so we don't want to join in that particular party. The other risks, as I was sort of alluding to, the unknowns, if you like, very difficult to point to them, but I guess we're watching closely, particularly investment in the tech sector in the US. You know, just if we see evidence of overinvestment, if we see the market starting to worry about that more, then, you know, if you're asking me what the next potential systemic risk might be, that might be it. But again, who knows? I mean, we could have another COVID next year. Hopefully not. But you've just got to manage what you can and insure against the things that you can't control.
Yeah. Just to follow up there, if I may, Justin, in terms of the inflation and that staying high for longer, do you have any red lines? Is it terms of US bond yields, or is it inflation prints, or is it just you're going to wait and see and you'll sort of know when you know?
No. You certainly look at the prints. Yep. More to the point, you look at prints versus expectations. Right. And bond markets certainly give you a very clear signal if there's an issue, as they have recently in Australia, right? You know, so it's very easy to see. The trick, though, is to be positioned for it beforehand rather than waiting for the data to come out, which is what we try and do.
You talked about building portfolio defence in a June commentary. What levers are you pulling to help make that happen in the portfolio?
There's a few. So I mentioned insurance earlier. So for us, that takes the form of tail protection. And it's somewhat unusual in a fixed income fund, we will actually buy put options, equity put options in our funds. We spend an amount of premium in all of our funds. So if there's another COVID, you get 8 to 10 times your premium. That's one form of insurance. And then there's the things you would expect us to do as a fixed income manager. So you're limiting your interest rate risk where you think that's appropriate. You're limiting the amount of credit spread risk that we have in the portfolio. We're doing those things now. If we become worried about anything in particular, we can do things like move up the capital stack, or we can take higher rated paper into the portfolio, increase liquidity. Going into COVID, we increased liquidity in our portfolios to up to 50 to 60% of assets. So we can move quite strongly when the circumstances demand it.
Justin, now I'm interested in this. You've argued that fixed income benchmarks are flawed for portfolio construction, so picking a bit of a fight there. Why do you make that argument? Then what implications does it have for the way that you structure your portfolios?
How long have you got?
As long as you need.
Yeah, no, I mean, fixed income benchmarks, we don't like, particularly in credit.
Yep.
Now, most of them are capitalisation weighted in fixed income as they are in equities. What does that mean in credit? Basically, it means you're investing more in the issuers that have more bonds outstanding. Now, in credit, that's the exact opposite of what you should be doing, right? So that's probably the main issue we have. In terms of the concentration of interest rate risk, they have usually 5, 6, 7 years of interest rate risk. We think, as I've said earlier, that's way too much interest rate risk for most investors. And we saw in 2022 what can happen if that goes wrong, right? Yeah. So the sorts of volatility you get in a portfolio from that, we just don't think it's fit for purpose. So for us, it's about stepping away from those benchmarks and thinking, right, well, what do investors want from fixed income? Typically what they want is an income stream with low volatility, right? And they want to know that, whatever the objective of the fund is, that you're going to meet it in most rolling time periods. So that's how we've set up our portfolio construction to ensure that, we can do that with as little volatility as possible.
Justin, I don't want to labour risks too much, but right now, as it currently stands, as we sit here, I should say, what's the scenario that's robbing you of sleep or keeping you awake at night? In the Daintree war room, what are you guys focusing on?
Ultimately, it's not so much the unknown. You can't pick them. You try and insure against them, as I've mentioned, but you don't know how long, if something like that happens, how long it's going to go for, right? So COVID, that was a month or so, and markets were sort of getting back to normal, and economies weren't, but markets had sort of started to move on. But I've lived through 2007 and 8. That's an instance of where markets took a very, very long time, as we remember, to move on. And so when stress carries on for a long period of time, that's what we are concerned about. So it's about not so much identifying the systemic risks, because as I've said, you can't really do that ahead of time, but it's ensuring your portfolio is as resilient as possible. Can you raise liquidity quickly? If not, then, do you have an appropriate sort of portfolio construction, right? So for us, we're very clear about being able to raise liquidity very quickly. And, are you in assets that you can sell? And in particular, if you need to orient the portfolio in one way or another, do you have the instruments at your disposal? So, derivative instruments, for example, we can use to very quickly change the interest rate exposure of our portfolio or our credit exposure, whatever it might be. Just having those tools and the flexibility to use them, really, really important.
Yeah, no doubt. We've talked enough about risk. Let's focus on the opportunities now. So what's the biggest opportunity that you're seeing in your space that perhaps also other investors might be missing? What's something that you guys have identified?
Sure. So in fixed income, look, I've got to be honest, risk premia at the moment are compressed, right? Credit spreads are quite tight. We alluded to that at the beginning. But as I've said, that's the case everywhere. That's the case offshore, and Australia is less impacted by that. But actually, it's also the case in other asset classes, right? Equity markets are expensive. So we're actually seeing in our flows, people coming to fixed income, taking money off the table, right? So for us in the portfolio, it's okay, how do we put that to work? We like structured credit in Australia. You're still getting some decent pickups over, say bank paper by investing in structured credit. We invest in a little bit of warehousing, so that means taking some of these deals before they come to market. You get a bit of pickup for that as well. Yep. There's some of the things that we like, but at this juncture, it's about just trying to be as defensive as you can. You don't want to chase returns too hard when credit spreads are tight. So I think the risk element that you've talked about a bit, definitely called for.
Make sure you're getting paid for the risk that you're taking.
Absolutely.
Yeah. Let's end looking forward. Justin, I don't need you to crystal ball anything, but again, just coming back to 2 or 3 indicators that you're really focusing on for the next 12 to 18 months that'll be important in terms of the way you construct a portfolio.
Inflation I've mentioned. Labour markets are important.
Right.
You have to be, you have to be looking, I think, at labour markets quite deeply. It's not about saying, right, well, the unemployment rate's gone from X to Y. Why has it done that? Do you think it's going to continue? And if not, why not? So we do quite a bit of analysis on labour markets.
Just on that, sorry, if you don't mind me asking, because I was actually reading an article about the US labour market recently. Job growth has slowed down quite considerably, and I'm sure you've seen the headlines of late of the likes of Amazon and a few of the other big tech companies actually starting to no longer hoard employees as they did after COVID. So what do you make of that, Justin? Is there anything to be seen there, or is this the start of a process?
It's potentially important. Yeah. One of the things that's interesting about the US labour market is that you've had a supply side issue, right? You've had, if you remove workers from the available pool, then that's going to change the statistics. But what you haven't had is layoffs. Right. So, when you see really strong sort of demand weakness and people going, right, companies going, this is enough, we need to lay off our staff, typically a last resort. And that is, I guess a pointer to weakness in the economy that's more widespread. We haven't seen that yet, right? So if some of those announcements come to fruition, we'll be looking at that very, very closely.
Makes sense. Sorry, I derailed you there. So the labour market, and there was one other.
So the labour market, inflation, and again, you've just got to be scanning the universe of risks at all times. You're not going to foresee everything that comes your way, but it's about being creative in your thinking to try and figure out, well, what might come our way, and if it does, is the portfolio set up appropriately to deal with that? We think we've got a portfolio that's set up appropriately to deal with most risks that would come our way, but every cycle is different. Every risk that hits you is different from things that have come before, even if the cause is similar. That's what makes financial markets interesting, right? So absolutely. That's why we're here.
Justin, thank you so much for taking us through that. Appreciate you spending the time.
Cheers, Chris. Thank you.
If you enjoyed that interview, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.